Doomsday is here. I'm your host, Steve Van Metre, and thanks for joining me today. And legendary hedge fund manager Michael Burry is back, this time warning investors that stocks could drop 53% before bottoming. Let's head over where we picked today's story up with big short investor Michael Burry warned the biggest market bubble in history would end with the mother of all crashes. He just hinted the collapse is now underway. Michael Burry sounded the alarm on the greatest speculative bubble of all time in all things last summer and cautioned investors buying into the hype that they were headed for the mother of all crashes. Doomsday is finally here, he hinted in a since-deleted tweet this week. And the fund manager of the Big Short fame shared a screenshot of the S&P 500 chart showing the benchmark stock market index has tumbled 18% from its December peak despite several blistering rallies this year. And yet I keep getting asked, when crash, he tweeted, poking fun at some of his followers' poor spelling and underlying his view that the market collapse is underway. And part of this is, a lot of investors don't understand. They see a move down in the markets and they think, well, that's the end. It dropped 25% and that's kind of a mild bear market. It must be over. Or it dropped 35%. Well, that's the average bear market. It's got to be over. And what happens is it's much like a roller coaster. You come down and all of that gets washed out of the market, and then you get a little upswing and everyone just breathes a sigh of relief, said, well, the worst is behind us. And then what happens is there's another big dip. And that's what happens in bear markets. You get these big moves down, followed by a relief rally, a big move down. And all it is people buying into the hope that the worst is behind them, when, as Burry says, the worst is yet to come. And let's take a look at that since deleted tweet. And what he's showing here, and my circling in red, is he's saying, look, this is the beginning of a topping pattern that's going to lead to stocks heading much lower. And Burry made that the S&P 500 could drop as low as 1,900 points or another 53% over the next year based on how past crashes have played out. Moreover, he has dismissed the rebounds in stocks this year as bear market rallies or dead cat bounces, temporary reprieves along the road to an inevitable disaster. And if stocks were to drop about 50% from where they are today, you're now talking about stock prices going back to where they were in 2015. If you can only imagine, that could be your generational buying opportunity. The Zion Asset Management chief stance seems to be that the boom of markets is over and the stocks are headed downward, and any rallies will prove short-lived and probably should be sold. Jeremy Grantham, who we covered in yesterday's show, another doomsaying investor and market historian, also shrugged off the recent upturn in stocks as a bear market rally and a new research note entitled Entering the Super Bubble's Final Act. And like Burry, he warned of an unprecedentedly dangerous mix of hugely overpriced assets, commodity price shocks, and a Federal Reserve intent on curbing inflation by cooling the economy. And the Fed has made no bones about it. They want to see stocks come down, and they want to see them come down now. And that is their plan, is to pull asset prices down until inflation breaks. And each cycle is different and unique, but every historical parallel suggests that the worst is yet to come, according to Grantham. And where the worst shouldn't be coming is to your portfolio in this mega crash that Burry and Grantham are predicting. I'll put a link up here to Portfolio Shield and the description below, because what I want you to do is look at the news, and this is something a lot of people don't do really well, is just look at the news and try to determine, is the worst behind you or is the worst yet to come? And when we look at what's coming, it tells you we're not out of the woods yet. Because check this out, Amazon closes abandoned plans for dozens of U.S. warehouses, and they plan to close the Maryland facility with 300 plus workers in October. And according to Amazon, they've reduced the size of their sprawling delivery operation, get this, amid slowing sales growth, and has abandoned dozens of existing and planned facilities around the U.S. And not only that, but they've killed plans to open 42 facilities totaling almost 25 million square feet of usable space. And again, you think about, is this something you hear in an economic boom of slowing sales growth? We're going to close down plants. We're going to shutter factories. We're going to reduce our footprint. No, those are all things you hear during a recession or going into recession. How about we look at the lending space? U.S. mortgage rates on the rise, hitting the highest level since the end of June. Now, is this something you hear during a housing boom? No, it's just the opposite. because the surge in mortgage rates this year has led to a sudden sales slowdown. And with fewer interested buyers in the market, sellers are holding back. And with the 4 weeks through August 21, new listings dropped 15% from the same period a year earlier. The biggest, get this, annual decline since the start of the pandemic. And again, is this telling you that demand for real estate is coming back? No, it tells you it's going the opposite direction. And the economy moves really slow. So it takes time for these things to actually hit the economy, suggesting that, again, things are likely to get worse before they get better. And China's growth prospects weaken as economists cut 2023 forecasts. And the world needs China to be growing because they're a big nation of consumers. The downgrade suggests economists aren't convinced that Beijing's recent stimulus measures, which more recently include 1 trillion yuan in funds largely for infrastructure projects and central bank rate cuts, can help counter the slowdown. And what have we talked about on this show? What comes if they can't get the stimulus to work? That's right, they devalue their currency. That's the last shoe to drop, and I expect to see that from China at some point in the future. And how about this out of Europe? Their energy crisis deepens after Russia keeps pipelines shut, as a crucial pipeline will no longer reopen as planned after works. Europe was plunged deeper into crisis as Russia again halted its key gas line pipeline indefinitely, a move decried by European politicians as an attempt to use energy as a weapon. And what an effective weapon it is, because we need energy in our economies. You don't have no energy, no growth. Really plain and simple. So for Europe now, you're seeing what is their likely case? Are they likely to turn back and resume into an expanding economy? Or are they likely to further contract and maybe, if they're lucky, only have a recession, but likely seeing a depression coming in the near future? But continue on, because how about we look at the metal space? You see the metals rout deepens as China lockdowns add to growth fears. Again, not the type of headline you want to hear, as a wave of risk aversion hits the markets on Thursday, dragging copper down to a near 1 month low. Now, why does copper matter? Because think about this. Where do copper prices go when the global economy is booming or expanding? They're going up. They don't see them go down when things are getting better. It's a leading indicator telling you where things are likely headed and what Burry has been warning about. But browbeaten stock bulls wilt in the face of rising Fed hostility as the S&P 500's 19% drawdowns tended to foreshadow inflation peak, something we've talked about on this show. Its hands tied when it comes to unwinding supply snarls and tight labor market. Jerome Powell's central bank has made an unusually explicit target of asset prices, as I've made the case, with the one Fed bank president, Neil Kashkari, going as far as saying he was happy to see shares tank after Powell's hawkish turn at Jackson Hole. And that is the key point. The lingering danger for stocks is getting them to fall as its merits when it comes to relieving price pressures in the economy. Besides its chilling effect on consumers, a gutted equity market has usually been a prerequisite for subduing the worst bounce of inflation. And again, this is the case we've made on this show over and over, that the Fed really does want the stock market to come down. And if they can get it down, they bring inflation down. But the problem is, they bring it down, they crash the economy with it. Of course, when we see, as deflationary effects have historically started to kick in when the S&P 500 drops more than 19%, and it breached that level in June and is now once again approaching it. And with the central bank's goal to beat inflation, the equity market will be the catalyst, not the observer. With prices, employment, and wages lining up to give spending a boost, the Fed is only left with one thing: driving equities down in order to reverse growth. And here you can see a chart of the consumer price index in blue and the total U.S. stock market, or the Wilshire 5000, in red, both on a year-over-year rate of change. And what do you see? Equity prices in red start to contract and head lower, and then inflation comes down. Equity prices fall, inflation comes down. Equity prices trending down, inflation down. Here we can see it again. The stock market heading down, telling us that the plan for the Fed is bring stocks down, bring inflation down. And of course, when that happens, as Burry is predicting, well, stock prices aren't going to just stop going down. They're going to outright crash. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.